Welcome back to another YouTube channel. What? Welcome back to another video. This is going to be about how I look to play certain levels and why I hate calling certain levels support and resistance. I hate those words, and I'm going to explain why in a minute. A lot of times when we think about support, we automatically think, okay, it's time to buy, or it's time to, buy the share or buy a call. And when we think of resistance, we think, okay, it's gonna resist here. Subconsciously, we think we know what's gonna happen. So instead of saying support or resistance, the best thing for you to do is just say level. That's all you got to do. And how do I play these levels? How do I know if I'm gonna bet against the stock or bet for the stock? How do I know if I'm gonna be long or short? How do I know if I'm going to be bull or be a bear? Here's how. Most important thing is going to be watching the overall market. Now, I'm specifically talking about just day trading. If I'm day trading, I'm going to be very, very careful and most likely stay away from playing calls in a bearish day, and then be very careful playing puts on a strong day. Can you play puts on bullish days and calls on bearish days? Sure, but you just have to time it almost perfectly, and you have to be quick, because once it keeps going against you, it could get ugly very fast. So just to keep your odds in your favor, you might as well play puts or short on bearish days and go long on bullish days, or play calls also on bullish days. So how do you really know if it's a strong day or a weak day? You have to watch the overall market. And the overall market is the S&P 500, the NASDAQ, and the Dow Jones. Keeping an eye on one of these, at least one of these, is the best case scenario, because you're going to have a pulse on the market. If you're trading an individual stock without looking at what SPY is doing, the S&P 500, or NASDAQ, and the ETF for that is QQQ, or the Dow Jones, the ETF for Dow Jones is DIA. If you're not watching one of these, you don't have a pulse on the market, you don't know what's happening, you don't know if buyers are in control or sellers are in control, and you're trading that stock blindly. So, in a strong market, in a day where buyers are in control, prices are rocketing higher, here's how you want to play your levels. Again, so in strong markets, here's what you want to do. You want to play bounces, and you want to play breakouts. Now, a bounce is simple, right? So say you have a level here. A bounce could be something like this. It comes back down to the level, and then you buy there and you look to sell at a higher price. A breakout would be the stock going and making a higher high, and that could be a potential play for me, with the stop loss somewhere under the level. And then here the bounce also, that if you get in here, stop loss is going to be somewhere under there. So I'm either getting calls on a bounce, or I'm getting calls on a breakout. And that's exactly what those two are. It's exactly what it sounds like. A bounce, like a ball bouncing, and then you have a breakout, which is like something breaking out of a level. Now in weak markets, here's what you're going to do. And again, weak markets is markets where sellers are in control, prices are just going lower, and it's just absolutely red. It's a red day, things are just looking very bad, depending on who you're asking. So bears are having a blast, bulls are just getting crushed. On these days, you want to play rejections, and then you want to play breakdowns. Now, a rejection looks like this. Say you have a level here. A rejection would look something like this, and then come back down. That's a rejection. And the rejection is the opposite of the bounce. So as the stock goes to that level and starts to pull back, that could be a potential entry. Now, if you try to short this right here, when it's a strong market, what has a higher chance to happen is that, and it'll just keep pushing and go against you. So that's why you want to make sure that you're only playing rejections in a weak market. So it doesn't make sense to play puts if the market is holding. Okay. Now, in terms of breakdowns, here's what a breakdown would be. A breakdown is just something going under the level. So a lot of times people just get really confused because they don't understand what the market is doing, and they're trying to, play a breakdown when it's actually time to play a bounce, because they're trying to short in a strong market, for example, and the time that they're supposed to long it, they go short, anticipating that it's going to go down for whatever reason. And then the opposite of a rejection is the breakout. Some people at this level are getting puts, some people are getting calls, anticipating the breakout. Now, if you're anticipating a breakout in a weak market, more likely than not, it's going to go against you. So to increase your chances of having a profitable trade and getting the best bang for your buck and getting a good risk reward ratio and all of that, you want to make sure that you play bounces and breakouts in strong markets, and then play rejections and breakdowns in weak markets. That's pretty much it for this video. Thank you so much for tuning in. If you haven't already, hit that subscribe button. If you like this video, give it a thumbs up, share it with a friend, turn on your post notifications, and I'll see you on the next video.